and welcome to the latest Retire Well episode with me, Matthew. And as always, I'm joined by Joe. And today we're going to look at inheritance tax and estate planning. So we get lots of comments and questions as financial planners talking about gifting, how much can I gift and what's the tax implications, and also, estate planning, what is my estate and what can I leave to my loved ones without any tax to pay. So in today's episode, we're going to unpick some of those questions, talk through allowances and talk through, common planning that people do. So if we jump in to start with, how much can you leave to your loved ones and what is the tax rate for inheritance tax?
Yeah, absolutely. I thought a good place to start is to actually look at what makes up your estate at the moment, of what could be potentially due on inheritance tax. At the moment, your estate is all of your assets, all of your liabilities. That could be property, cash. It could even be certain gifts within a 7-year time horizon, which we'll come on to later. But it does, for the moment, exclude pensions. So if you've got a £500,000 pension and you die with it, that's not included for inheritance tax. It's currently excluded. And there's a couple of other rules with regards to that we'll come on to. For the non-pension assets, which are currently included in the estate for inheritance tax purposes, there's a couple of different allowances that you have before you'd actually get charged inheritance tax. So the main one that everyone will have is your nil-rate band. So your nil-rate band is £325,000, and if you're a husband and wife, then you could get £325,000 each, and then you're also entitled to a residency nil-rate band. So a residency nil-rate band is a little bit different to a nil-rate band, where a nil-rate band is all of your assets. It can apply to all of your assets. A residency nil-rate band only applies to your main residential property, and it will only apply if you pass it down to any direct descendants. And that residency nil-rate band is at £175,000. So if you think about a married couple with 2 sets of nil-rate bands and residency nil-rate bands, they can have up to £1 million in non-pension assets before they would be charged inheritance tax.
Yeah, definitely. Joe's done the heavy lifting on the numbers there, but the simple answer when I talk to clients is to say, if you've got less than £1 million, of which, some of that's in property and it's being left to the next generation, then you don't have to worry about any inheritance tax to pay. If you've got assets that are in excess of that, that's when there's a potential inheritance tax, implication. And then it's a case of, are you expecting to spend and draw down money? Or if you think you're going to have these assets for the rest of your life, that's when you can start thinking about gifting and planning.
Yeah, and if you do have in excess of that £1 million or in excess of your nil-rate bands, any amount above it would be charged at 40% as the standard death rate for inheritance tax. There are a couple of planning opportunities where you could pay less than it, and we'll run through that in the rest of the podcast. I suppose the only other thing to talk about the main nil-rate band allowances is if your non-pension assets are over £2 million, then you actually start to lose out on some of your residency nil-rate band. They essentially say, well, you've got enough assets, we're not going to give you this extra relief, you don't need it, you're already passing down enough to your children or whoever it might go to. And then I suppose that the other one to talk about before we look at some planning opportunities is if you leave more than 10% of your taxable estate to a registered charity, they essentially say you've done something good with your estate, we're going to reduce the rate of inheritance tax that we charge you from 40% to 36% on that basis.
Yeah, definitely. And again, it makes sense to mention the pensions now. So again, lots of people who are here, Retire Well podcast, thinking about pensions. And there's obviously been an announcement recently that pensions are going to form part of people's estate going forward. So do you want to touch on that?
Yeah, no problem. So with regards to pensions, there's currently one, I suppose, age which you need to be concerned of at the moment. So if you were to die before age 75 and have pensions, and when we're talking about pensions in this instance, we're talking about the flexible pensions, the defined contribution pensions. There are different rules for defined benefit pensions, which are, I suppose, slightly more complex and different options that you have available for yourself. But any defined contribution pensions that you have, if you were to die before age 75, you can pass them inheritance tax free to your dependents, and that could be any nominated beneficiary. It doesn't necessarily have to be a children or a spouse. And then when they draw out from that pension, that is also completely tax free. So it's a completely tax free payment to whoever you've nominated your pension to. If you were to die after 75 currently, it's still free of inheritance tax because they're not included within your estate for inheritance tax purposes. But if they were to draw any money out of that, it's then essentially seen as taxable income being withdrawn from a pension in the same way that your 75% taxable income would be when you're drawing from a pension in drawdown. The changes from 2027 that were proposed in the autumn budget were essentially saying any unused pensions, so in this case we're reading it as defined contribution, flexible pensions, they will be included in the estate for inheritance tax purposes, charged at that potentially 40% if you're over your allowances, and then they'd pass in the same way as that sort of tax-free pre-75 and taxable when you're drawing out of it post-75.
Yeah, so again, to simplify it slightly, currently, when you're looking at your estate, we're looking at all your worldly goods, so cash accounts, your house, any assets, and then we're looking at any liabilities, so any mortgages or any debts there on a negative, and that would be your estate. And then with the new rules, you would then put your pension on top of it, and you'd be assessed on against the same numbers that Joe described earlier, the nil-rate band, potentially the resident nil-rate band, and then you're looking at those, inheritance tax at the same rate.
Yeah, and I think it's important as well. Although we know that this is on the horizon and there is going to be some form of change, we don't know exactly what that change is going to be at the moment. So when we're looking at with our clients, we're assessing what would an inheritance tax bill be now and what will an inheritance tax bill be in the future. Not necessarily putting anything permanent in place at the moment, but just having one eye on how could we plan for it if something does change between now and 2027.
Yeah, I think there's no point ignoring it, but equally you don't want to change everything dramatically because you don't know what's around the corner. Again, it could be, change of politics going forward, a change of legislation again in the future, or equally you could say, we're doing all this planning, we're changing things, and someone could pass away or be hit by a bus, and actually they would still be taxed under the current rules, having then done something to change it to try and plan for a future. So I think that's a sensible approach, but it's almost just understanding and knowing the inheritance tax position, and then you can start to plan at the right time.
Yeah, absolutely. And when we're looking at inheritance tax planning and estate planning in general, it can get quite complex with lots of different intricacies and lots of clever planning pieces. Probably some of it beyond the scope of the podcast and where you really need to seek sort of regulated financial advice. What I thought would be good is just to run through some simple things that everyone should consider, at least in the first instance, that will almost help you plan basics how to pass on your estate to your beneficiaries.
Yeah, definitely. And I think the most sensible first one is to say anyone with any assets should have a will, and that is then just clearly to nominate who they want to benefit from those assets, and it just makes it easier for your loved ones in terms of administering it and controlling it going forward. But it also just means that you've regularly thought through what you want to have with assets, and you've avoided family arguments or debates to say, oh well, I thought I was getting this, or I thought so and so was getting that. Again, just having it written down as a legal document is the best way to do that.
Yeah, and I think that's particularly important as well with unmarried couples, because when you're looking at that case, it might be the case that you want everything to pass to your partner and potentially your child that you have. But if you don't have it in the will through the laws of intestacy, which is, I suppose, the standard, if you don't have a will, your partner wouldn't inherit anything. And if you were planning on them be provided for and they're not, that could really impact someone's life going forward. Yeah,
definitely. Recently in the news, there was, Liam Payne passing away. And when they came to look at his estate, he didn't have a will. Again, he had significant assets as a pop star. And when you see the newspaper stories now, there's no provisions there for his girlfriend. So all the funds are essentially going to his son in trust because he wasn't married. So again, that might have been exactly what he wanted, but actually because there wasn't written down and there wasn't the legal document, there's a little bit of uncertainty, and it gets that wiggle room where people can be frustrated or say, okay, that's not quite what we expected to happen. So yeah, certainly, even if you're married, it makes sense to have a will just to make the transfer estate more efficient. You're not then having to write away to get any extra sort of legal documents. You've got the ability to say to pension providers, bank accounts, all your assets, here's the evidence of what the individual wanted to happen, and then they can administer it as smoothly as possible at what is a difficult time.
Yeah, and I think it almost goes without saying that if you do leave your estate to the laws of intestacy, it's inherently not tax efficient, because the government have essentially wrote the rules on it, and why would they allow it to be more tax efficient than it needs to be? So they'll just pass through essentially a flow chart, and it'll go to whoever it should do.
Yeah, or potentially to the Crown as the end result. Again, I had one meeting with someone where they said, I'd like to leave all of this to nieces and nephews, and then I said, okay, have you got a will in place? Oh no, I don't need one. And then when you went through the laws of intestacy, it did cover potential beneficiaries, but actually, their beneficiaries weren't named. So actually it would have gone straight to the state rather than going to their named beneficiaries. So my first bit of advice for them was, get a will as fast as possible, because, you currently, the biggest risk to you is if anything happens and then actually your loved ones aren't getting anything.
Yeah, and on the topic of sort of nominating beneficiaries, the pension death benefit nominations are very different to a will. They can sometimes, if there isn't one, they would lean on the will and look at who it should pass to. But most of the time, it's best to use an expression of wish or a death benefit nomination with your pension to let the pension trustees know who it's going to. And we've spoke about it in the past, and most people would just put their spouse as 100% and not really have any consideration for the children. Yeah. We've spoke how a good planning point there is, if you've got 2 children, put 98% of it to your spouse, the other 2% to the children, just so that the pension providers know that was part of your thinking. Yeah. And then that could allow you on death, or your spouse on death, to be a little bit more flexible with how the pension's paid out. And with those potential rule changes coming in 2027, that could again be a really good planning piece on death that could help with that.
Definitely one of our early episodes was about, what happens to my pension when I die. Again, if you find that point interesting, it's definitely worth going back and watching that one. I think, really, as you say, it's about having every option available, and then it's giving your family who are left the ability to then say, okay, what's our circumstances now, and what are the rules that we've got to use them? Again, a pension shouldn't be in your will currently, because if it was written into your will, it would be potentially taxable for inheritance tax. Whereas, if you just have the nomination, it stays outside. One very clever planning point as well is, instead of leaving assets like a pension absolutely to your beneficiaries, you could consider a trust. So again, if you said, I'd like to provide for my children and any grandchildren, but then potentially, unborn grandchildren, you might prefer to say, I'm going to leave 100% of my funds into a trust where I'm going to nominate classes of beneficiaries, and then essentially, if anything happens to me, my funds live on with people choosing who benefits based on my rules, but there's flexibility for that to change as more beneficiaries are created, essentially.
Yeah, there's some implications with leaving a pension to trust, where I would say, if you are thinking about that, speak to a financial advisor or a legal professional, just to understand exactly what the implications are. The last one of almost simple things that I think are no-brainers that you should be thinking about is to have a lasting power of attorney in place. So this could be a financial one or a health one, and essentially what that allows is you to appoint someone that, if you don't have mental capacity to make decisions on your behalf. So from a financial perspective, which we mostly focus on, that might allow them to access bank accounts if they're codependent on yourself, or it might let them make sometimes limited, but some changes to how your inheritance might pass if you're unable to. And that allows you to almost keep up to date with legislation, even if you're not mentally able to make the decisions yourself.
Yeah, I think powers of attorney are a brilliant tool to enable someone to still have the ability to act on your behalf if you're unable to. COVID was that perfect example where Kate Garraway's husband was in a coma, and I think it was EE wouldn't cancel his phone contract, Again, that seems stupid, but they wouldn't listen to her and they wouldn't take her authority to cancel it. So even though he was in a coma for a long period of time, that bill kept coming out. For my mum, she's got me on one power of attorney for the finances, and then she's got my sister who's a doctor for the medical side of things, so she feels like she's got good provision. For other people, it's just about finding that person who is the right person, that if you were unable to act and you needed someone to almost put a hat on and think like you, that's someone who you would appoint as your attorney. Again, the legal cost for that is about £82 per power of attorney, and you could do 2 each potentially. So again, it's a very low financial cost, but with a potentially massive financial saving and psychological saving as well.
Yeah, absolutely. So I think hopefully that's given you quite a good base of what inheritance tax is. The next thing that I suppose we'd look at are the common planning tools. So outside of those simple things that you should do to make sure that you're essentially taking care of your loved ones, is what can we essentially do to try and reduce that inheritance tax bill on death. The first one that we're going to speak about, I think there's probably quite a lot of misconceptions around this on what you can and can't do. We're going to talk about gifting. Matthew, do you just want to give us a bit of an introduction into gifting?
Yeah, definitely. I often get people, getting in touch or on the phone and saying, Mum or Dad wants to make a gift, or I want to make a gift to my children, but I'm really worried that there's going to be tax implications. So, to start with, there's no implications. Someone can gift anything they want, and as long as they live for 7 years, there's going to be no tax consequences for that. Also, if someone's estate is lower than the tax figures that we've already talked through, those nil-rate bands and the residential nil-rate band, there's no implication for giving large gifts, but some people get really nervous and really worried because they read things like an annual gifting allowance. So there are allowances, and we can talk through those, but they're really to say that these funds then drop out of your estate immediately, and therefore you're not having to say, these are going to be still accounted for going forward. So do you want to go through the allowances?
Yeah, absolutely. We've spoken about quite a lot of them before. The main one that most people know is a £3,000 gifting allowance, where you could gift it to anyone in the tax year, and that's immediately outside of your estate without having to wait those 7 years. You can also look back 1 year as well. So if you forgot to do it last year, don't worry, you can still do it this year. Outside of that, you've got small gifts, so you can gift £250 to anyone, as many different people as you want. You'd probably have to gift to a lot of people to reduce some inheritance tax bills, but that's the gift that's on offer. And then the other allowance is sort of wedding gifts, where you can, dependent on how close you are to the person getting married, you can gift a certain amount with less the less close you are to someone. Those are sort of the general gifting allowances. I just wanted to touch on what Matthew said there with regards to you can gift as much as you want without any immediate tax bill. We probably should clarify that is to other persons. If you were to make a gift into a trust, then you are limited to the sort of the nil rate band of £325,000, and then you could potentially pay a lifetime tax of inheritance tax, which reduces from 40 to 20. But again, that's where we're talking about
this is where it becomes quite complicated.
Yeah, it gets quite complex. Again, gifting into trust is always something that you should look to seek professional advice on, legal and financial. Gifting between friends and family is a little bit more simple. But yeah, Matthew, do you want to run through the 7-year gifting rule?
Yep. So essentially, as we described there, if someone's making a large gift, so if someone said, okay, I've got £50,000 which I don't expect to spend, and I would rather give that to my daughter for a house deposit, if I give her that money and transfer it across, again, I've given it absolutely, so I'm not going to have any ongoing benefit from it, and I don't expect to almost have the money back at any point, but that would still sit in your estate for 7 years, and that is essentially to stop someone going, I'm in ill health and I've got an estate that's well above an inheritance threshold, and I'm therefore going to just say, okay, I'm going to give it all to you, and therefore, when I pass away, there's no inheritance tax to pay and you've got the funds. So that 7-year, lifespan for the gift basically says it's still in your estate even though you've given it away for those 7 years. And that then allows people to say, from a planning point of view, you could start to go, okay, I've got 7-year cycles. So how many 7-year cycles have I got between now my normal life expectancy, how much of my assets am I looking to give, and therefore what the things am I comfortable to give. Again, if it's to an individual, there's no limits. If it's into trust, again, you've got to think about the nil rate band that Joe described. And then one of the most, underused rules, I think, is the gifts out of normal expenditure. And that is essentially to say, in the same way that Joe's described the rules like the £3,000, the £250, you can actually gift 100% of your surplus income and it would be immediately out of your estate. So there'll be no 7 year to think about, as long as it doesn't impact your standard of living, and also as long as you can document that it's not capital that's being given away and you have got that surplus income. And the way that's done is really to look at the HMRC's forms that are filled out as part of the probate process, and that's saying for each tax year, what was someone's income, what was their expenditure, what was the difference, and it's that difference that can be gifted.
Yeah, I think the key with gifts out of normal expenditure is make sure that you've got a clear record of what the gifts are, make sure that it's a clear intention to gift on a regular basis, as Matthew said, and it's not a one-off gift. And the thing with this is it's not something that's claimed during your lifetime, it's claimed on death when you're filling out inheritance tax. Well, you won't be, but your executors will be filling out your inheritance tax forms.
And crucially, if you don't have the records, if someone's there, if they haven't got the evidence to defend it, then they haven't got a leg to stand on. When someone has got the records of this was the income, this was the expenditure, this is the surplus, therefore they can turn around and say, look, clearly this is the evidence. And when you're not here, they can't come and ask you, have you got that bank statement, or have you got that pension statement? So again, that's where doing this planning in your lifetime is crucial.
Yeah, absolutely. We're going to touch on trust just briefly, because again, I do think that could be almost a whole episode in itself of all the different trusts that you can do.
Yeah.
But generally, you can look at gifting into a trust in your lifetime. One of the ones that is quite common is you might look at creating a trust with your will, where you'd look at using that nil rate band, which is the amount that you can pass tax free, put that in a trust to the side, and then the rest of your assets will pass to your spouse tax free. So that's one way that you could look at it. And then there are also some more complicated trust structures that can help from an inheritance tax point of view as well.
Yeah, and crucially, if you do that, if you put £325,000 into a trust on death, you then aren't leaving your nil rate bound to your spouse. So as those figures we described before, at that point you're almost carving some of your estate out for future beneficiaries, and you're then not leaving the transferable nil rate band that we mentioned before.
Yeah, and that's actually probably something that we should have mentioned at the very start, and I think we've glossed over it because in my head it's something that's almost just natural that happens. When you're leaving assets to a spouse, there's no inheritance tax that's chargeable. It's the same way in your lifetime where you can transfer cash from yourself to a spouse with no tax incurred there. On death, you could pass all your assets to your spouse with no inheritance tax.
And just to make that crystal clear, that's to say that if your estate was £2 million, £3 million, if it was above allowances, that's still fine. Essentially, the tax will be paid on second death. So you can say you've built up assets as a couple, you then intend to spend them in your lifetime. If someone was to pass away and there's still more than half of the funds available, the second surviving spouse can then draw on more of those. Again, we're looking at sustainability of income, and some people might, add up all their assets and have figures above the inheritance, figures and the thresholds, but they're happy with that because they expect to draw down on funds and spend it in their lifetime. Again, we find people spend more in the early years, then they might start to accumulate wealth with things like the state pension and guaranteed income sources. So it's that regular review of assets as you go through against those rules that should, and that's another thing we should say, the nil rate band has been fixed for a number of years. There's a view that really it should be inflation linked, but from almost a stealth tax, it has been frozen for a number of years.
Yeah, absolutely. So we've talked about a couple of planning options now, and we'll continue to talk about that a little bit later. One thing I think that would be good to look at now is if after we've done gifting and after we've already reduced our estate and we've still got an inheritance tax bill to pay, what's one thing that we can do there? One thing that I think that should be always looked at and considered, not necessarily always taken out, is looking at life insurance. So it's possible to take out a life insurance for the sum of the inheritance tax bill. So say that's maybe £100,000 inheritance tax bill. And the way that I see it, it's almost paying a little bit now towards the sum of the inheritance tax bill, so that when you pass it to your beneficiaries can inherit 100% of your estate, and you've almost done them a nice one and paid that inheritance tax bill in advance.
Yeah, definitely. We see this as the simplest way to solve an inheritance tax problem, that you can say to someone, you have options, you can gift money, and you can then say that's no longer in your control. Again, someone might say, well, actually, no, I quite want the assets in my lifetime. Again, I've had a client who's had a couple of properties, and therefore lots of their assets aren't liquid. And then they also go, okay, well, I don't want to sell these properties, so I don't want to then do large gifts, but I've still got an inheritance tax problem. You could do high risk investments that we're going to come on to talk about, the benefit from some of the reliefs as well. But the simplest approach is to say life cover. And yes, as you're older, life cover is more expensive, but you're also going to be paying it for a shorter period of time. So it's looking at that balance. We've looked at some policies with people recently to match their inheritance tax liabilities. And actually, when we look at normal life expectancy, even if they were to live 5 years past normal life expectancy, they would still be leaving more to their family than they were paying in the premiums, which is, the point of trying to preserve assets for the long term.
Yeah, absolutely. So outside of life insurance, what are some ways that you could almost combat the IHT liability? Matthew, you mentioned looking at sort of different reliefs that are available. Do you want to just give us a quick run through of what they are and how they may apply? Yeah,
so people will have seen the farmers kicking off recently about changes, and that was because of the impact on business relief. Traditionally, there was business relief, which could have been agricultural property relief, or it could be business property relief. And that was the ability that essentially someone was taking a bit more of a high risk approach, or was leaving assets like a farm to a family member, and therefore they benefit from some allowances. And you had the traditional sense of actually owning the farm yourself, but you could also then invest in qualifying companies that invested in that way, and you would get the same relief. Do you want to run through the reliefs?
Yeah, so usually it'll be a 100% relief for that unlisted business, as you said. What's been limited, which is what farmers weren't too happy about, is that's now been limited to the first £1 million of a business, with 50% relief given thereafter. So instead of being charged the usual 40% inheritance tax, you would be charged 20% inheritance tax, and you can also spread that over the course of a number of years with that sort of relief as well. So it is for most people that have got a family business and are passing it down, that's essentially what it's for. I think the reason that this legislation was brought in is sort of the other side of it, which I suppose is the clever financial planning side of it, where you might have a client that's got a large liability and you want them to essentially invest in a riskier business to get this relief. I think that's where this legislation's essentially come in.
Yeah, I think there was an irony where, Jeremy Clarkson was the sort of poster boy for their campaign, when people like him were actually, weren't farmers who were getting the benefits of the inheritance tax saving. And then they were complaining when the inheritance tax bit was taken away. So again, there is a slight irony there, but in the traditional sense, the protection is still that you've got an asset available to be left to the next generation. But they were trying to say, if you were, a billionaire who wanted to keep buying lots of farmland for the sake of leaving it to the next generation, that's the bit they were trying to limit, so to speak.
Yeah, and it should sort of, an undernote of that, it needs to be held for at least 2 years, any sort of the business property reliefs to apply for the relief. If you have sold a business, you are able to purchase another one and have the relief almost carry over. But again, with that sort of planning for inheritance tax, that's one. Again, I feel like we've said it quite a lot in this episode, you really need to be speaking with a professional to understand the exact pitfalls and advantages of each.
Yeah, definitely. I mean, in the simplest sense, you've got the ability to invest in high risk assets that would fall out of your estate within 2 years. Obviously, that's a lot shorter than the 7 years of gifting money away, and you've still got access to the asset. So for some people, that's perfect. But we find with lots of our clients and lots of people that we talk to, the extra risk just isn't something they're willing to tolerate, and they prefer going down the route of insurance and potentially gifts as well. And you can almost say, you could actually insure against some of the gifts. So when we say they stay in your estate for 7 years, you could actually say, if I pass away in this period, what would be the liability just from this large gift? And you could, instead of taking out a whole of life insurance policy, which might be more expensive, you could just take out some life cover for those 7 years, so that if there's no pressure on you to live more than 7 years.
Yeah, absolutely. So I think it would be good to just move on to a couple of common questions. The first one is something that we probably get quite a lot as financial advisors, but we're probably not best placed to answer it. So I suppose we can talk a bit around it and then point to the correct profession. But we get a lot of the time clients come to us and they go, look, I'm looking to, and it might be twofold. They might be looking to avoid any future care fees and also protect from an inheritance. And they'll say, should I put my property into trust? Matthew, what would you say to those clients?
I don't love that, but again, lots of people want to do it. I think the reason why I don't love it is because to be truly a gift, you have to not have a gift with reservation. So if I was to say, I want to leave my property to the next generation, but I want to carry on living there, that wouldn't work unless I start to pay market rent. So in theory, then I've given away my property, and then I'm also going to have to pay for the rest of the time I live there, so that I'm not continuing to benefit from it that way. You then say, if anything happens to the beneficiaries who you've given it to, you might say, okay, if they went bankrupt, if they had a divorce in the future, you aren't in control of your property anymore because it's given away. And you've just got that limited flexibility with all of that. So I sort of see it as a very high risk approach in the sense of what you're trying to look at, whether you're gifting it to someone absolutely or whether you're thinking about trusts. There's legal costs involved, there's potentially tax implications. Again, if someone's already got a house, that might be their second house, and there might be more stamp duty or other things if they were to sell it, or capital gains if they were going to sell it in the future. So there's really more to think about. I quite like severing the tenancy and leaving half of the property in a will. So if a married couple own a property together as joint tenants, naturally, as one of them passes away, the other person owns 100% of the property. What they can do is sever the tenancy so they're tenants in common and they own 50% each, and 50% can then be left in their will, potentially to their children. And that way, when you're thinking about care fee planning, you've already ring-fenced half of it, but crucially, you haven't done anything too aggressive with a planning point of view.
Yeah, you're usually one that quite like to avoid jargon, Matthew, so we've gone through all of it there. No, I think it's some cases it might be right, some cases it might not be, and again, it's just about understanding the consequences. I think the loss of control with putting it into trust is the big one there, and equally, when people are looking at it from a care fee perspective, they don't think about what's called deprivation of assets, which is essentially you think or there's a chance that you could go into care, so you're trying to deprive yourself of assets so you don't pay the care fees, and the local authority will essentially look at it and go, well, we still should be due that. So that's another thing to think about.
If you've done it intentionally, exactly, or if you've done it a short period of time before the care need, again, it's easy for the local authority to say that wasn't actually the real reason you did it. So yeah, I think in general, it's worth a conversation with a financial advisor and potentially a solicitor, but also, there is the more plain vanilla planning where, as we've talked about, gifting, trusts, life insurance can be the common way to solve a problem, rather than being too aggressive too early and then finding that you actually regret what you've done there.
Yeah, absolutely. I mean, we've got a couple more questions here, but I realise that we've run through quite a lot already in this podcast, so it might be worth almost saving them for another podcast, and we can almost do a Q&A episode where we look at some of the questions we've already had, both with regards to inheritance tax, pensions, and all the other things that we've talked about in podcasts. I think, as Matthew said, for this episode, key takeaways are: understand the simple things, do the simple things with regards to wills, lasting powers of attorney, and that sort of thing. It's inherently complex, inheritance tax planning, so always seek the professional advice. Matthew, do you have anything to add to that?
I think I'd just say, as you've mentioned there, we want to do more episodes on this, so if people have got specific questions, please leave them in the comments. Again, we'll pick up lots of the frequently asked questions in a future episode, and as always, thank you for listening, and we've got more episodes coming on Tuesdays.